here, but just want to jump off with our weekly update. So I just want to cover kind of a few things here this week, kind of general market update, like always. I want to talk about kind of one of the key drivers of what's driving this crazy market. And then we talked about mortgage rates and kind of what's coming, what are the thoughts, what to be looking out for. So we're going to kind of hit that last. So as always, if you have any questions, if you're watching this on a recorded basis, you can still put in questions in the comments on Facebook, and we'll see those and be happy to follow up with you with whatever questions you've got. So with that said, I always start off with the whole corny, hey Jeff, how's the market? Well, I can tell you right now, it's crazy. We had 2 listings go live over the weekend, one price in the mid 500s, one up in the 600s, upper 600s, and both are absolutely crazy. Slammed with showings, multiple offers. They're both under contract, obviously. It's absolutely nuts. The veracity of the market right now, there's just simply no homes. So we're going to kind of get to that here in a second. So we always start with these kind of slides. Last week, remember we saw the big 30-ish% drop in lockbox activity. That's every time Gene and I open the door. Well, it's bounced back, right? The ice storm, it's done, and people are back out in full force. So look for this number to continue to skyrocket week over week, because I can tell you right now there are a lot of people out looking for houses right now. Across the river on the Vancouver side, same thing, 34% growth. They're bouncing back as well. So it is absolutely nuts. I would almost hazard to say that Vancouver might even be more active and more crazy of a market than Portland, which is kind of hard to imagine. But Vancouver's got a little bit less inventory than we do, slightly more favorable pricing for now. So it's crazy on both sides of the river. So if you're looking to be buying a home, make sure you're working with a good team who knows how to help you be better positioned for success, because it's tough. So let's talk about this for a little bit. The big thing that's driving the headaches for a lot of people right now, headaches, or even for sellers, it's a bit of a headache because it's so chaotic and crazy right now, is our lack of inventory. If you know me, this is my favorite chart that I've ever created for us here. The blue bars are inventory levels for any month. This goes back to January of 2000. The orange line and there is the average price of homes in the Portland metro area. And then the little green section there across the middle, that's just highlighting 4 to 6 months of inventory. That's what we would consider to be a balanced market, meaning things are somewhat normal, doesn't favor one side or the other. Life is good at that point. And outside of the Great Recession period, you'll see we really haven't been there in 15 plus years, and I don't see us going back anytime soon. For the month of January, we're at 1 month of inventory, which is a stark improvement from the prior month. But still, it's kind of a long ways to go, so that's not helping us much there. So that's kind of a look, kind of a high-level snapshot of where we're at. So let's kind of talk about kind of a few things of what's causing some of this inventory compression here. So if we go through and look at kind of another way to look at this, the blue flooded section on this chart here, these are your total active listings at any point in time, going back for forever in the Portland metro area. Homes available for sale. And then the orange bars at the bottom are closed sales transactions. So when you've got obviously a high number of active listings, much lower number of closed sales, obviously you've got inventory accumulation because things aren't moving as quickly. Now progress towards current days, and that gap is gone. It's actually the closed sales are surpassing in some cases the active listings, and thus we simply have no inventory. So if we don't have the active listings, why is that? What's kind of driving some of that? Well, the easiest way to show that is here's your new construction starts. This is the Portland and Vancouver metro areas as reported by Fred out of St. Louis, Federal Reserve data. If you look back prior to the Great Recession, right, the Great Recession is the big gray section in the middle. The gray bars are always recessionary indications on Fed charts. Through the Great Recession, you had a plummet of new construction activity, right? Because obviously nobody's buying houses back then, so no one's going to be building houses. Builders were bankrupt, builders left the market, so on and so forth. But if you look at that trend line basis from the left side of that gray bar versus the right side, more like current times, you'll see we're down. This is where we've talked about we've got an 8 to 10 year deficit of not building homes to keep up with what we saw happening previously. So keep that in mind. And I've got a slight technical glitch here where my handy dandy folks here decided not upload a slide. So here we go. Okay. This is the population growth for the Portland metro area going back to from the year 2000 through this is through 2020 or through 2019, I think perhaps. But kind of a linear growth. The population in the Portland metro area has been booming over the years. We talk about this all the time. United Van Line surveys, U-Haul surveys. Portland is a net migration area simply for easy to understand facts. People want the West Coast. They love the Pacific Northwest. They want lifestyle. They want affordability. And if you look up and down the West Coast and Pacific Northwest, we are the lowest cost major city to be had. So people come here in droves, particularly the millennials. We showed that, I think, a couple weeks ago. Millennials are driving what's really happening on the population growth in the Portland area, and they're entering home buying stages. So they want to buy a house. More people than not have recognized there's value to the home. So more people moving to the area, more people wanting to buy homes because of low mortgage rates, not building enough new home inventory. 1 month of inventory. So that's horrible news for us. So, and this is also why I say I don't see this getting better anytime soon, because once you factor in the urban growth boundary, there's no place for them to build homes, even if they wanted to. And then to offset that 10-year deficit, the only way you do that is with a 10-year surplus, equal and above, even factoring in the population growth. And just quite honestly, I just don't see that mathematically happening. So that's the state of your inventory right now. We're not building it. People are buying it. It's absolutely bonkers right now in the market. So one of the big fuelers of that is obviously the record low mortgage rates. This has been in the news all the time, left and right. And we've had a bit of an enigma. And if Riley Hayes with Root Mortgage watches this, sorry, Riley, part of this is going to look super familiar from your newsletter. I'm stealing part of this from you, so sorry about that. But he put out this graphic in his newsletter. Historically speaking, mortgage rates follow the 10-year Treasury note. So it gives you a pretty good predictor, pretty good idea of where mortgage rates are headed based off where you see 10-year Treasury notes going. Going back to around the time that COVID hit, you saw this divergence, what in Riley's graphics calling it the cushion, right? So you had 10-year Treasury yields going this way, you had mortgage rates kind of going separate and independent of that, and not necessarily following on a direct basis what you would expect to have seen from Treasuries. You see the 10-year Treasury in this case tanked, mortgage rates kind of held in for a while, then slowly started to adjust and catch up, but not to the magnitude of the 10-year Treasury. And that kind of created this enigma period of time with a lot of people looking at like, what's happening? This is not how these two indicators are supposed to react with each other. If you look at what's happened here recently, that cushion has evaporated. We're now back to mortgage rates are now following the 10-year Treasury yields once again. So that gives us a little bit more predictability, gives us a little bit more direction of what's happening. Now, if you look at where that blue line's doing towards the end of that chart, it's going up. So you've heard a lot of people talking about, keep an eye on mortgage rates. They're going to start trending up. The Fed is committed to buying securities and keeping their base rates low for the federal funds rates, which should indirectly help. But obviously 10-year Treasuries are starting to price up, recognizing we need to kind of offset here a little bit. Now, a big part of what's going to be driving this up now is going to be kind of a factor of things. But first and foremost, it's already hitting the press. Mortgage demand is dropping as the mortgage rates are rising their fastest pace in months. And again, you know me, I call these things out. It's stupid. I even included the first bullet point. It's skyrocketed all the way to 2.98 from 2.96 on a $400,000 mortgage. It's a $5 a month difference. Anyway, so that's a skyrocketing rate in this article apparently. But the sentiment is there that we are starting to see the increase in rates. There have been predictions for quite a long time that we'll see rates in the threes throughout a lot of this year. So the 2.5, 2.75. I heard stories not that long ago of somebody getting a 2.1 rate, I believe, or 1.9, something crazy on a 15-year refinance. Those days, I think, are gone. So if you're kind of waiting for a rate bounce, you might get one back. I don't think you're going to see 2 3/4 probably ever again. So I think your clock is ticking here a little bit. A big part now of what's fueling this is, again, we've got mortgage rates are back following the 10-year Treasury. The big thing that's going to drive those 10-year Treasury rates are things that you would typically think are going to be good news. People getting back to work, the economy firing up. We've also got the government is spending a lot of money on stimulus and facilitating vaccine rollouts and so on and so forth. So people worry about deficits, and put all that combined, people start talking about inflation. And as you're talking about inflation, you're going to start seeing those 10-year Treasury rates pushing up higher and higher and higher. With that, you'll see the mortgage rates following. So again, here, expectations of the faster economic growth and inflation are continuing to dominate the yields and pushing those rates up higher. So watch for that, because it's sort of a good news, bad news. So what's going to help pull us back out of this economic funk we've been in is probably going to throw a little bit of cold water on the party for the mortgage rates. That said, for us here in the Portland area, I would argue we're going to be pretty well insulated on a home price basis, simply because the supply is not there. So while the purchase activity may slow down, I don't see prices going away anytime soon. I think if nothing else, we're going to go from this double-digit growth of prices, which is unhealthy and unsustainable, down to a more moderate level. So whether it's 3%, 4%, 9%, who knows? The 20-year annualized average is 4.7%. So 5% on a leveraged investment such as a house, not bad. So there you go. So watch for mortgage rates to go up. If you're trying to time the market and wait for things to get better, things to get softer, things to get easier, prices to come down, waiting for rates to come way back down, so on and so forth. Maybe I'll eat these words later, but mark my words, it's just not going to happen. There's nothing out there that's going to help facilitate that. So I would say, instead of sitting trying to wait and time the market, jump in. This is the time to make your purchase, make your move up, do what you're going to do while rates are still arguably low, still a tick below 3 with credit, income, so forth. But you get the gist. I don't see this getting much relaxed anytime soon. There's just nothing out there for it. That's your update. 12 minutes. I'm getting better at this. So again, if you have any questions after having watched this, want to discuss strategies or talk about what you're looking to get done, we'd love to have that conversation with you, either Jeannie or myself. Just reach out. Otherwise, if you've got questions, post them on comments when you see this on a recorded basis on our Facebook page. We'll be happy to follow up with you either publicly or privately, whatever your choice is. Otherwise, that's it. We're done. Have a great week. We'll talk to you next time.